Today I'm going to discuss a very important topic that is the need of ours at the moment. Everyone is filing the UAE Corporate Tax Return, and then while filing, they have several questions. I was receiving a lot of inquiries, calls about getting for them and assistance. So I felt let's build up learning material which can help the masses. This is all focus on UAE corporate tax return preparations. Broadly, we are going to discuss today a couple of issues. So the things to learn today will be what are the objective of this training, how the corporate tax works in UAE. As you understand that the base of this tax is almost similar to the HMRC in UK. So there are a lot of similarities I find. I'm going to tell you what is the actual overview. We will see that how FTA, the Federal Tax Authority, thinks about corporate tax, what expenses they believe is acceptable, and what expenses they believe is allowed, not allowed, permissible or not permissible. This is what is the most important to know for any accountant for filing the return. So we'll see what is an expense recorded as allowable according to the FTA perspective, how to start the corporate tax computations, what are the fully allowable expenses, without any problem, they are 100% allowed. Then we'll see the entertainment and hospitality expenses, how to deal with them when it is for business or when it is done by a director or when it is done by an employee. Motor vehicles and mixed expenses. Sometimes we use a car for personal use and the same car will be used for the business. So how to deal with such scenarios, this is I'm going to discuss right away. Every business has some kind of finance cost or the cost or the interest cost. We will discuss what is the perspective in that. And obviously we are going to discuss which expenses are completely non-allowable expenses. In any shape, we are not allowed to put them in expenses and reduce our profit. Couple of expenses are mixed by directors who are the owner. So we'll see what are the personal expenses, how to treat them. I'm going to take a bit of deep dive in that, and I'll let you know more details about it. We'll see capital and revenue expenditure, provisions and accruals. Very important part of the financial statements. We'll see if same owner has multiple company, whether you create a group or not, what can be the issues that you need to know and understand. Some businesses have done some kind of charities and they are believing by themselves that it is subject to an allowable expense. However, we have to see that how to incorporate donations, which donations are part of the allowable expenses and which are not, so we can plan these donations in a better way. How FTA audit really works, and what common mistakes generally businesses are doing, which can trigger for them an FTA investigation. I believe as a professional, we need to be prepared always. It's not that I receive a letter that FTA wants to an audit, then I start looking. No, that's not an approach. We have to work in a quality way. We have to prepare our documents well in advance in a better way so we can exactly inspire and impress the FTA team that we are a well-organized organization. Even we are small, no worries. What documents are required, and we will do a complete comprehensive case study in order to understand how the return should look like. And obviously, then I'll give you some professional closing advices. So let's start with the first topic, and I'm going to discuss with you is what is allowable and non-allowable expenses. Before that, I should tell you the detail that this training that we are conducting is for the UAE Corporate Tax, which is new but strictly enforced. Most FTA penalties arise from the expenses misclassification, so that's why I feel appropriate to give you more insight about these topics. Incorrect expense treatments leads to either overstated deduction or invalid relief claims from FTA, and it can cause a trigger for FTA, and they can call you for, they can choose you for an audit, and later they can impose penalties if your accounting treatments are not appropriately done according to the FTA understanding. This training focuses on real-filling behavior, not theory. So I'm not going to talk any theoretical modeling. I'm just trying to talk in a very clear way, which is the real expenses treatment. The corporate tax compliance is not about paying more taxes. It's about paying the correct tax and defending it confidently. That's what is my message for all the accountants listening to me. By the end of this session, you will be able to understand how corporate tax return should look like, what are the allowable expenses, what expenses are partially allowed, and what are not allowed at all. That's what we are going to discuss, and we'll see that how the FTA compliant tax adjustments we can do. We can prepare our tax computation. We can handle SMEs. If there is a relief, I'm going to tell you how long it is valid for and how to claim for that, because you have to claim for it, so it's not automatic, and how to respond FTA for any observations that they have. This training is, of course, it's not a bookkeeping session, it's not a memory task, it's not based on assumptions. This training is based on UAE corporate tax law, executive regulations, FTA guidance, and a practical audit expectations. Now, what should be your professional expectations? After this training, you should be able to justify every expense you allow or disallow. So you start thinking about your profit and loss, and you see an expense in your eyes, you can say it is allowable or not allowable. That's what is the target for today training. Very clear and very confident. So let's start our discussion. UAE corporate tax, obviously, as you understand, the UAE structure, the companies in two ways. One is you have Department of Economy that we call as DED. DED is a mainland, they call it as mainland company incorporation. And it has, so before it used to be our UAE national, but they allowed a couple of years before that you can own it by yourself. So, and on the other hand, we have some designated zone, which are considered as free zones. So they're equally free as the mainland. It's just the name free zones, which is we use. These free zones means that you are not a mainland company and you are registered to operate in that particular zone. And this zone has its own operator as a regulator. So that's what is, we have to see what is the difference between mainland corporate tax rules and what is a free zone entity zone. And free zone entity may have a zone that is designed for tax free. So there are a lot of things to learn. Let's start it in a way. So corporate tax is based on income, not on the revenue. So it's not, we're not talking about tax on sales. That's a different terminology. We are talking about income minus expenses, revenue minus expenses, gross and net, and then we get income, which is, we have to determine first what is a taxable income, and based on that we have to move forward for that. So there are standard rates if your sales or if your income is less than 375,000 dirhams, it is zero tax. If you exceeded that, you have 9%. So the ultimate tax in UAE is the lowest in the world, is 9%. You might be surprised if I tell you in some countries the taxation goes as high as 55%. And if you make £1, you get 0.45 pounds. So that's why UAE is becoming an attraction for the billionaires to be able to live as a resident so they can get the tax benefits. I do a lot of global tax structuring. In any ways, it is one of the most favorite things. I like it. And obviously, like any country, so if your accounting year finish in December, so next 9 months you have to file your return. So that's 9 months for your preparation, your review, and your adjustments. Before I go for the expenses, let's talk about, a lot of questions comes to me, what is a small business relief? So that's what I want to explain before I move forward to the expenses. So UAE is a very good country in a way that they support the businesses, especially the small businesses. Small businesses are the ones that really need a government support because their profit margins is not that way and their turnover is also not that good. So small business relief is a temporary corporate tax release where your revenue is not exceeding 3 million dirham. Revenue threshold is for tax period, which is currently available up to 31st December 2026. So we are in 2026. So it's still valid at the moment when I am making this video and talking to you. Relief is optional, so you have to opt for it. It's not automatically that you say, okay, I'll put the figures, I'm below 3 million, so I'll get a relief. No, you have to opt it. I'm going to show you how it works. When a small business relief is applied, the entity is treated as zero taxable income, which is a great incentive from the FTA and ultimately from the UAE government. Very smart, very efficient, and very, very promising. I must say, genius comments like that attracts the people all over the world because of their taxation strategies. Corporate tax payable becomes zero because there's nothing, zero multiplied with anything is zero. However, the business still have to prepare your financial statements. So it doesn't mean that you are free from any kind of documentation work. No, not at all. Now, after corporate tax comes in the country, make sure that your set of documents are updated. You're using a proper software. You keep the records for at least 5 years with you, because even you close the company, you still have to have your records for next 5 years. So it's getting really serious and sensitive. So start taking your corporate tax extremely serious. Analyze expense correctly, make tax adjustments, file the corporate tax return on time. Otherwise, you can get a penalty for that. Now let's take a quick example. If your turnover is 2.4 million, which is obviously below 3 million, and your accounting profit is 500,000, half a million. So what will be your relief is your profit above 375 will be taxed at 9. So your taxable income is zero, your corporate tax zero, and corporate tax return need to be filled. So that's the way you need to look around, because if you don't have a relief, the free 0% is 375, anything above is 9%. So you have to pay 9% in normal circumstances, but because you're a small, medium enterprise and FTA is very kind to support you with a zero rate of tax. Let's talk about free zones. Free zones entity may qualify for corporate 0% tax it relieves only to the qualifying income. So do you have to see your income qualifies for 0% or not? What does it mean in a simple way? That you're conducting those activities which comes in a qualifying activity table. Then you meet the economic substance requirement and you comply with transfer pricing rule. 2, 3 very, very useful. I have separate lectures to explain all of them. And you can review them later. Now I'm focused on the expense allocation. Non-qualifying income is taxed as usual as 9%. So again, like if you're a smart business owner, you'll come to me and ask, can I register in a qualifying free zone where my income will be qualified for 0 return? And that's what is the amazing tax planning that I generally do for my clients. So free zone company earns, let's say take an example, 1 million and your non-qualifying income is 400,000. So qualifying income 0, non-qualifying is the full tax rate above 375. Expenses must be allocated correctly between income streams. That's very important that we are going to discuss shortly. Incorrect allocations can result in disallowed expenses, means that expense was not allowed, it was, so you put it as allowed. So you have to see like disallowed, loss of free zones benefit, and obviously it can trigger a call from FTA for a detailed audit. And the critical compliance that you need to make in yourself, that is very important. Reliefs don't eliminate the requirement for keeping your documents and filing your return. You have to file a return, even if it is an empty one. Do not eliminate filing. Do not override expense disallowance rules. Personal, non-business, or restricted expense must be add back. So if you have already entered them in profit and loss, these expenses need to add back. You remember when we used to do the cash flow, the first portion adjustment, like for non-cash expenses, we take the profit, we add back depreciation, amortization, and the working capital adjustment. You remember all that. I'm just recalling. So the same way, we have to take the profit and we have to add back in our net profit to adjust the profit first and then calculate the taxable income for us. Incorrect relief significantly increase your FTA audit risk. And reliefs are privileges. They are not the right. So privileges has to be taken in that way. Poor expense discipline during relief years can cause serious problem in later, because any random audit comes and they check it that the relief was unjustified and it can create a complication for you. Now let's start is that what is an expense allowable? What expenses are allowable wholly, exclusively, and where you don't need to worry at all? An expense is deductible for UAE corporate tax if following conditions are met. Whatever you are, you're a chartered accountant in England and Wales, CPA, USA, Australia, whatever. Just keep in your mind that you have to follow the FTA conditions. And FTA says incurred wholly or exclusively for business purposes. That's really important. Properly documented and evidence recognized under IFRS for SME, recognized under IFRS for SME. So you need to understand the international financial reporting standard. You have to understand what is IAS, what is IFR, what is IFR 7, 9, what's the IFRS 16, 15, lease financial disclosure financial presentations. This all need to be known to an accountant who is going to make the financial top of it the law for taxation. Not specifically disallowed under corporate law. Failure any condition, expense becomes non-allowable at all. So conditions are really important. How FTA thinks about it, they are wholly means the expenses entirely for business. Example, you are a business owner and you paid a salary to an employee for work. Extremely clear, wholly, fully an expense. Exclusively means there's no personal benefit. So maybe you took a business lunch and it was not your personal, so it was exclusively for personal, not for personal benefit. And there is a dual purpose that we need to adjust it according to the rules. And FTA applies substance over approach. I have a separate video on that. You can watch it on YouTube. That will be more better. Now let's take you have a client dinner. It was business purposes only, so it is 50% allowed. So assume that you paid 500 dirhams and 250 will be an allowable expenses for your tax. Obviously in accounting, you're putting full expense that you made for the business, but for the taxation purposes, it will be 50% allowed. You went to a director's family dinner, or if director went to a family dinner, there are kids and wife around them. So this is a personal visit for a director. It might be used the company card for payment, but it is 100% disallowed. Home internet used for work and personal, you can allocate. Show in a couple of situations where you can justify. I always say if you can justify that this particular expenses, this much is for personal and this much is for business, we can definitely allocate reasonably to the return. Now let's talk about point of corporate tax computation. So how we do it. So first of all, we start the accounting profit. Normally, every software is giving you an accounting profit. You have income, you have expenses, and you got your income before tax. And so what we do is we first of all your financial statement should be based on international financial reporting standard. And then what we should do is take the income from income statement, add back those expenses that are not allowable, and then deduct those ones which is require a deduction. And obviously there are a couple of that require an adjustment. Let's take some practical example. Accounting profit is 600,000 and your disallowed expense, the expense that was for dinner of a family, which you has put in income statement. Now it's the time to add back. So we will add back 70,000 as the disallowed. Now your total income has increased, and then you apply your tax rate based on if you are an SME or you are paying the full. So it is really a starting point for you. Let's talk about the fully allowable expenses, which is 100% deductible. So expenses that are clearly, directly linked to the business operations are generally fully deductible without any question, curiosity. And the best, easiest example is salary, your benefits, office rent. Obviously that office rent, which has, you have an ijari for that. That is the one. If you don't have ijari in UAE, that cannot be considered your rent. Then we have to do a different proposition for that. It is subject to the approval of FTA at the end. So utility that are coming in the company name and your telecommunication, software, ERP systems that you bought, audit, accounting, taxation, our fee is fully deductible. So if you pay more fee, you'll get less profit and less tax in the end. So what are the explanations? You enable business operations, do not provide personal benefit, are expected in normal commercial activity, means they should not be abnormally done, and FTA rarely, very less, is challenging those expenses because, I mean, if you are a mainland company, you have a labor record, you pay wage protection system, your salary, so everything is all cross-matched, all payment related to employees. So that's more dependable because another government body is controlling that part. So anyone will be not in a good sense to play around with these expenses. Staff salary fully deductible, audit fee fully deductible, accounting software fully deductible. Even allowable expenses can be disallowed. This is, we will see case to case basis. And if your invoices, contract, and payment proofs are missing, because when FTA asks you to send these invoices, five that, and if you are missing with them, then obviously they will be. This will spark a suspicion, and it can be a problem. Very interesting topic that we are going to discuss is the entertainment, hospitality, and restrictions. So entertainment and hospitality expenses are particularly restricted. Obviously, they are the most sensitive. They can trigger an FTA inquiry. So you need to be very, very careful. What's included in entertainment and hospitality? One is client meal. You took some meal with the client. Business entertainment, hotel accommodations, client gifts, which are not advertised. For example, client dinner, you took 10,000, 50% is allowed. So 50% need to add back in your taxable income. Staff only events, trainings are 100% deductible. So you can see like FTA is very logical. Anything happened which is clear, transparent, as for your staff, for training, development, yes, put them in expenses. That's not an issue. But when a director is playing around, doing personal expenses, personal trips, try to have fun and then come back, give the bill to the accountants and ask them to put in the business, that's what is not, even it's not a good ethical practice, to be honest. I mean, do a good business, be a gentle person and do ethical practices. You'll see your business will grow. Now, motor vehicles expenses are the same. Like if I have a car and I am using it to drop, say, for example, my sister or brother to the college and the school, and then I coming back, going to office, I fill the tank for a week. So I need to know that who is going to bear this expenses. So motor vehicles often have business and purpose, fuel, insurance, repair, and depreciation. These are four important expenses that an SME business is having. So business portion is allowed, personal portion not allowed. Allocation must be reasonable and consistent. So that's really important. Don't overstate, understate, keep it fluctuating because the usages always have a trend. Total car expenses was 40 and the estimated was 70. So allowed is 28. Disallowed is 12,000. There are a couple of situations. If the car is owned by someone else, it's a rented car. Very simple. You know, we're a business. We have rent a car. We are paying from the pocket. Obviously, this is all business expenses. Problem comes when the car is owned to someone else. There is no direct connection between business and others. So obviously, then FTA has discretion. They can look into more deeply and try to assess what is the real situation. Finance and interest cost. Every business has interest costs, finance costs. We have to say it. Interest costs are restricted. Expense including bank interest, Islamic profit, and loan arrangement fee. So explanation is interest limitation rule. Net interest deductible is capped on 30%. So up to 30% you can accept it. More than that, we have to add back in the income and increase the income. So all interest is not acceptable. It's just a 30% cap rule that you need to understand. So let's see, like you have, take a numerical example. You have 300,000 dirhams and your interestable is 30%, which is 90. and actual interest happened is 120. So the disallowed will become 30%. So that's what is the very simple and easy. Any excessive interest you try to enter in your tax return, you are exposing yourself on an FTA investigation. Let's talk about completely non-allowable expenses. So when you see them, you say, oh yes, that's not allowed. So penalties are not allowed, traffic fines, because they are not business generated. They are penalties. They are to penalize you. Their nature is punitive, not commercial. So we don't actually accept it in any case. So FTA penalties, traffic fine, regulatory penalties. FTA also fines you if you are late in registering your VAT or a similar kind. General provisions and non-approved donations. Now, what are non-approved donations? FTA has some charity on their what you can approve list. If you give charity to them, yes, you can. But for the rest, obviously, no, not allowed. Penalties, not commercial. Dividends are profit distribution, not expenses. Provisions without real liabilities are speculative. So any speculation is not subject to any approval. So we have to add them back, okay, in the taxable income. Very clear, very straight. Don't do such mistakes at all. Topic 11 is personal expenses. I'm going to go a bit deep dive into so you can understand. So personal expenses are the cost that are benefiting the owners, their families, directors. They are not for genuine trade purposes and would exist even business does not exist. Like you still drop the kid to the school, drop the wife, drop the father, pay for medical expenses. And FTA is very clear that these are personal expenses and they should not be entered in the businesses for nothing. So don't do this. Try to, every person, every business knows by heart that this is a personal or this is, so be straight. Like there's no gain. I mean, this is a country like UAE, whatever tax goes to, it's come back in the public welfare. So any country like this, we should give full tax without any trouble. Common personal expenses. So you have a personal travel. I already explained you went to Mauritius, you went to Morocco, you went to Casablanca, and you booked a hotel. You like Arabic food and all that stuff isn't allowed. Family staying in other rooms using your card, school fee, university fee, personal groceries, home rent. Here I will tell you, like, if you send your employee for training, yes, it's allowed. But if a director owner paying their kid's school fee, putting in the business, not allowed at all, not allowed. Don't be too smart. Home rent paid by the company, personal bills, private medical expenses for non-employees, and the personal vehicle fully paid by the company. So these are some personal expenses, and we need to be very clear. They are 100% disallowed, must be added back, and there is no partial allowance required for that. Very serious, very strict. Okay, let's take an example. Director is traveling to London, expenses paid, flight 12,000, hotel 10,000, shopping 10,000, total expense book 30. So trip include family, personal benefit, no segregation. All 30,000 is disallowed. Add back in the income, apply 9%, and that's the treatment. A rule, if the business stops tomorrow, just think in this way, logical way. If your expenses still continue, then it is not allowed. If the business related, yes. If you can make a clear distinction between a business expense and a personal expense, definitely there is no issue. Let's go a bit of accounting term. We have two kind of expenses. Capital, when you buy equipment, machine, plant, machinery and equipment. And revenue, when you pay your day-to-day expenses. So that is the difference between both. And in accounting definition, any expense that consumed within 1 year is revenue, or benefit exceed over multiple years is the capital one. And obviously, capital expenditures are not immediately deductible. So what you do is you charge an asset and calculate depreciation or amortization, put them in your expenses, and that's the way it works. What are the common capital expenditure your business might bought? Some plant, machinery, office, websites, which are larger side, not the normal one, like our intangible business acquisitions, goodwills. So what you will do is you will take the total cost, useful life divided, and you will get 24. That is your depreciation that you need to add back. So allowable depreciation is this much, add back is this much, net disallowance, tax impact is above that is 9%. So go through these calculations and they are pretty straight, and you will see what is allowed and what is not allowed. Let's talk about provisions and accruals because they are important factors and they are a little bit shaky. I mean, provision by definition is an estimation. So estimation, obviously tax is not interested in your accounting estimates, to be honest. So the FTA distinguish between the real liability and the speculative. The speculative is not allowed at all. As I told you, accounting reporting, financial reporting is different mindset, while a tax reporting is totally different. So what is allowed provisions? You have employee-related, accrued expenses, salaried service, already received amount is measurable, reliable. Disallowed general provisions excluded, future losses excluded, contingent liability which are in dispute and you're not sure what will happen with them. So you classify according to the contingent assets and liability provisions, but for taxation purposes, they are totally different. Business buffer provisions also, provisions for replacing assets, all that provisions are disallowed, means add them back in the income and increase the taxable income. So here is a scenario. Company creates EOSB provisions. 80,000 is allowed. So future is 50,000 disallowed. Add them back, put them or rate on that. That's simple. Let's talk about related party transactions, high scrutiny. Related party, I will not discuss now. I'm going to talk later on that, a separate lecture. Let's leave it for the time. Let's talk about donations and CSR. So donation, as I told you, if it is approved by FTA, it is okay. If it is not, then it is in general, they are disallowed. So we say that donations are not business expenses. These are emotional or goodwill intentions and not equal to tax allowance. So FTA have some qualifying public entities. For example, you give to donation to local charity 40,000, they don't accept it, so you have to pay tax. But if they accept it, yes, that is the simple one. So how to give charity? Just ask the FTA about those public benefit entities. If you pay them, you will get the benefit outside. What are the common mistakes accountants makes with the real impact? So I'm going to explain you already as of now, after all this discussion, you might have seen that a lot of personal benefits included in the business. So that's the behavioral and judgmental errors. So you claim, 80% accountants in UAE, they're not familiar with the rules at the moment. I wish this will educate them and things get more better. So claiming 10%, 100% entertainment expense, ignoring personal use and expenses, capital items, treating directed expenses as a business cost, weak or missing documentation, assuming SME relief, no tax work, and no expenses review because tax is low. Absolutely a bad situation. You need to work hard on them. And in order to be an effective tax accountant, you need to work on these things and you'll become an expert stuff. Now, what FTA is looking, FTA audits are risk-based, not random. So they always trigger by the risk. That audit has certain methods. So one of them is risk-based. It can be transaction-based. It's maybe the contingency base, but risk base is the one that they use. So when they see too much high entertainment cost, low profit because of directed high expenses, repeat personal cost, interested party and inconsistent over the year expenses and relief claims with poor discipline. So that all causes FTA is for an audit. For example, a company revenue 5 million and their expenses 450, it's almost 9%, which was absolutely high. No one have this much of expenses. So a detailed review will start 50% disallowance. You already know that. And additional penalties will come to you for incorrect filing. So always have a qualified accountant contact Berkeley, and they will sort out your stuff very easily. Now, what documents we need to always prepare? You should have a better trial balance. You should have financial statements, your invoices. Now we have software, we upload the invoices. You don't need to keep a physical file in the office. You can, of course. It's an old way of doing things, but now we have a soft copy. We have to keep it forever. And the bank statement, asset register, tax computation working that you submit, you should keep it with you because that will never be entered in your accounting software. So you have to keep it as yourself. And your car and phone and your food and your petrol, all these allocable expenses, you have to take care of them. That's great. So I think this is quite enough for the day, and I hope that you will get a lot of benefit from this. If you feel that really benefits you, you can like my channel and subscribe it. And for any other videos, any other topics that you feel you need some advice, you're always free to contact me. With this wish that you will understand the corporate tax more comprehensively, I will leave it for the time being, and I'll see you in my next video. Till then, wherever you are, just take care of yourself and your surroundings. Goodbye.